Aggarwal joins us now. Good morning. Thank you for joining us. What should be a very basic strategy for our viewers who are watching the show? They want to benefit from your expertise. What would you advise them? If you've endured the gain, now endured the pain, now wait for the gain.
Yeah. Hi, Nicole. Thanks for having me. You see, I think as the situation stands, we might have seen the worst kind of a panic in the market. And it happened in the say, previous quarter, you can say in the run up to March, there was a lot of panic that the economy is going down, markets are going to crash. But eventually, as it happens every time, the markets are always a leading indicator, and I think they have stabilized for now. So I don't see that kind of a pain setting in the near future. That is one. The second is, however, that the ride will be slow, and it is the time still remain to be very choosy when it comes to investing in say specific stocks. Because as we have seen time and again that, like you were saying, you can say there was froth in a lot of stocks. I think there were much more number of stocks where the small caps, micro caps, where the valuations were 40 times, 50 times. So I don't think those stocks are going to come back in a hurry. But yes, it would be a very, I would say it will be a stock pickers market this year. And I think the companies or the sectors which do well, I think the stocks gradually will bounce back one by one.
Interesting you say that. So, Amnish, what's looking like a safe pocket other than financials, which really seems to be a consensus trade on the street right now? Other than that, what's looking like a safe haven of sorts?
I will split them into two parts. One is where the current performance seems to be reasonably good. Say, for example, you look at, say, your entire infra, cap, goods, engineering space. There, the numbers, the orders, they continue to pour in. The performance has been good. The stocks are now better down. That is one pocket. The second pocket is, you can say, the space of, say, your hospitals, stroke pharma. So that is another segment which is relatively better off in comparison to others. But then there is another segment where there is a lot of hope. The entire, you can say, and the third one currently doing well could be, say, tourism. But one, there is hope depending upon how the demand scenario pans out, and where there's a lot of hope that maybe another 2 months, 3 months, the demand should revive. And that is, you can say, the entire consumption baskets, whether these are, you can say, durables are down, building materials, FMCG, retail, QSR. So this entire broader consumption market where there is no big, you can say, fireworks happening as of now. So that could be, I would say, one where there could be a clear trade in select stock of, say, maybe 15%, 20% for the next 6 to 12 months.
Okay, which are those stocks? 15-20% next 6 months. Acha return aa sakta hai. Tell us. Tell our viewers. They'll be happy to know. 15-20% in 6 months, 8 months. But that's a good return.
Yeah, you see, the main thing is many of these stocks, even the frontline ones, they have seen very sharp correction, particularly post-September when the demand actually tanked. Now, I think all the pointers, if they go in the right direction, and we have got the low base in the first half. So I think once the recovery starts happening, I think by December, I think this can actually materialize. In many of these stocks, it should happen.
A very interesting note coming in from Goldman Sachs, at least. And, they're talking about what are the ideas wherein they see actually upside in this market, and what, according to them, is a safe haven list right now. So let's just bring up what they find attractive right now. And they're talking about how the benchmark index has actually corrected 10% from its peak, which was in September 24, but then has also seen a recovery as well. While that fall was driven by EPS growth following a slower macro, as well as sharp correction in the valuation multiples across segments. They've talked about 10 stocks where they think they're going to offer a good 23% upside from the current levels. I mean, the obvious name there is, of course, HDFC Bank, but AU Small Finance as well is one other pocket that they are actually liking. They've also talked about as to how they like M&M. We've seen how resilient M&M has been in the current market fall as well. And ever since the market began its recovery, it's really come back to the fore. The surprising names there is not Interglobe Aviation, is not Adani Ports, but a power grid finds mention in that note. There's Apollo Hospitals that they like, Godrej Consumer, and hold your breath for this one, Make My Trip. That's something that they believe could be a very good play on this entire travel and hospitality boom. Amnish, you were just talking about hospitality, right? I mean, other than the pure play hotel plays, you think a Make My Trip, Ixigo kind of models also make for good investments?
See, the entire space is actually booming. And my sense is that as the discretionary spending goes up, all these companies are going to benefit. Now, I don't have any definitive target on, say, your Ixigo or Make My Trip. But if you want to play the travel space, then in addition to hotels, aviation, I think these are some of the segments which the investors can definitely explore.
Okay, Navneesh, let me come to you and let me actually get your view on gold financiers in particular. How are they all looking to you, be a Muthoot or a Manappuram Finance? Because both of them have had a healthy run. The outlook has been good. Also with Manappuram Finance, you have the Bain Capital also going ahead and buying the stake.
The gold financiers usually tend to benefit because the gold prices have been rising. And overall, if you look at the unsecured market or overall, you can say there has been tight liquidity in the market. So in such kind of a scenario, all the gold financiers, they usually they usually tend to do better. Now, based on the current situation, I think with the gold prices remaining high, I think the overall scenario for both the stocks looks good. With the entry of Bain Capital, I think there will be more credence now to the numbers of your finance in particular. So I think even after the run-up, one can expect steady returns to come from these stocks.
The auto space actually, because the channel checks have been indicating that the recent months have been pretty weak when you talk about the PV sales or for the matter of fact for two-wheeler registration as well. And we've seen that actually trickle down when you talk about the way how the auto sales have actually been functioning. Amnish, what's your take coming in on the auto space? Do you think this one is something that one can avoid at this point in time, given the fact that you are not seeing a lot of good signs or good news when you talk about at least the registrations or the sales figures?
These auto sales have been tepid. You look at say past 2-3 months, even the two-wheeler sales of select companies, they have been pretty weak. But if you look at say auto space in general, I think one needs to be very stock specific at this point of time. Last year, full year, the PV sales were very tepid, and there are hopes that if the consumer demand picks up, if the discretionary demand gets better, particularly after your May June, then there could be some uptick in the entry to mid-level segment in the PV market, which could actually benefit players like Maruti. So I think PV stocks, for example, Maruti or you can say Hyundai to some extent, so they could see some bounce back as the demand revives, but it is all depending upon, you can say, the expected revival in demand. So I would say that as far as your auto is concerned, I would be constructive on the space, and one should be looking at buying the auto stocks. M&M is one of our top picks, followed by Maruti. In two-wheeler space, I think all the companies are having their unique problems. You can say overseas exposure, or for example, the sales have been tepid. But definitely, if there is some pickup happening on that side, I think which we should know over the next few months, then there could be, you can say, some uptick happening there also. But I think for us, as of now, your PV players, they look better than the two-wheeler space.
Sure. Amnish, auto components though, you think the threat is bigger there with regards to US slapping tariffs? I mean, you have companies which garner almost 30 to 80% of their revenues from the North America region, Motherson Sumi, Sona Comstar, etc. You think they are high risk right now?
Yeah, you see, the main thing is that as of now, we are not sure because as far as US tariffs are concerned, when it came to say even Canada, Mexico, and others, there has been, you can say, changes here or there or dilutions as we go along. But having said that, if the reciprocal tariffs are actually introduced, then some of the companies which are more export oriented, particularly in the North American and US region, I think there could be some cloud on the performance of these, and there could be definitely some reaction in coming in some of these stocks.
So that's the take coming in.
Stock in focus. They've approved a sizable 30,800 crore rupee FY26 borrowing plan. So look out for what that stock does. The news flow, of course, has been quite thick and fast in this one. And this month alone, it's notched up about almost 9% gains. Other than that, of course, Federal Bank. Interesting move there. They're looking to buy 4% in Aegis Federal Life for about almost 98 odd crore rupees. That's the other stock which is going to be in focus. And a bunch of order wins for NCC. 2 BSNL orders worth about almost 10,805 crore rupees. So that's quite sizable when it comes to NCC. Amnish, wanted to understand how is it that you're positioned right now within the entire infra/construction universe, and if you're liking anything there?
See, we don't have a formal rating on the infra stocks, but having said that, as I have been very vocal about it, that the kind of infra spends which are happening in India, whether it is at the state or the central level, I think there is going to be, you can say, enough order book for most of the companies. You look at all the frontline companies in the infra space. I will not go very deep down into the smaller names. I think their order books are going to be robust. And particularly some of these companies which cater to multiple segments, whether it comes to roads, ports, you can say marine is there. You can say all the infra spans, hydropower is there, and now even your solar is coming. So I think all these companies are going to do well. So if you look at the past few years, many of these large names, top 4-5 names, their balance sheets are today very good. There is not much debt in the balance sheet. The cash flows are strong. I think all these names will continue to do well, and I think there is not much risk also, because unlike last cycle when there was very aggressive bidding, the balance sheets were bad. I think this time around players have been very cautious in building up their order books, looking at the profitability. So I think all the frontline infra companies, we are very confident about that. I think they will still give you very steady returns from here on, although you look at, say, past 2-3 years, many of them have given multi-bagger return. But still, I think it makes sense to remain invested in all the frontline infra companies.
Right, okay, that's the entire...
I'm just trying to, bring out NSE, MCX, IEX, they have so much of moat around them that it is unbelievable that they cannot be replicated. Animesh is still there, right? Is there merit in buying into an MCX or IEX right now, Animesh?
You see, I can't tell the exact levels for the same, but definitely exchanges is one segment which is very attractive. You look at even, you can say, an NSE or BSE, you look at MCS. IEX is a slightly, I would say, different case in point, because if there is some change in regulation which happens at some point of time, then there could be, you can say, some risk. But I think for all the other stocks, I think these are something like the structural stories where you will continue to get, you can say, compounding as the volumes go up, and the operating leverage in these businesses is very high. So the more as the time goes by, volumes improve, I think the profitability is going to improve, and that eventually is going to reflect in the better stock prices.
That has got diluted. Can I say that?
Yeah, absolutely. You look at what has happened with, you can say, whether it is Mexico or whether it is Canada, and my sense is that all these tariffs are actually, they are being used for more geopolitical gains, and it is not going to change any, you can say, anything as far as economics is concerned overnight. So I think these are more like knee-jerk reactions, and their impact will only be in the very, very long term. So I think all these are, yes, some industries might be, you can say, gainer or losers, but not a very major impact.
There's the technical point. Kunal and Naresh, 23,800 on the Nifty.
And where one should place their bet. But Nikunj, talking about the markets, we've spoken about the Nifty resistance.
If you like this video, then like, share and subscribe to ET Now.